Hello everyone, welcome to the market opening bell on Monday, August 4th, your 10-minute guide to the stock market. Let's start with the US stock market. On Friday, US President Trump announced the deployment of two nuclear submarines near Russia in response to threats from former Russian president. Meanwhile, US July non-farm payrolls grew far below expectations, and Trump abruptly fired Labor Statistics Bureau Commissioner Erica McEntire, appointed by former President Biden, accusing her of manipulating employment data for political purposes. This triggered a sell-off in U.S. stocks. The Dow Jones Industrial Average fell as much as 790 points or 1.8% to 43,340, closing down 542 points or 1.2% at 43,588. The Nasdaq dropped 472 points or 2.2% to 20,650, and the S&P 500 fell 101 points or 1.6% to 6,238. For the week, all three major indexes declined over 2%. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, fell 135 points or 1.8% to 7,326. The Magnificent Seven all declined. Amazon issued a pessimistic profit forecast, with its stock closing down 8.3%. Apple reported better than expected Q3 revenue, with a 13% rise in iPhone sales, but fell 2.5% after an initial 3% gain. Nvidia dropped 2.3%, Meta fell 3%, and Tesla, Microsoft, and Alphabet each fell over 1%. Bank stocks also slid, with JP Morgan, Bank of America, and Goldman Sachs down 2% to 3%. On economic data, US July non-farm payrolls added only 73,000 jobs, below the expected 104,000, with June's figure revised down from 147,000 to 14,000, erasing 133,000 jobs. The unemployment rate rose from 4.1% to 4.2% as expected. For July, ISM manufacturing index fell to 48 from 49, below the expected 49.5. This week, U.S. markets will focus on four key points. One, new U.S. tariffs effective Thursday, August 7. Watch for negotiation progress. Two, Federal Reserve official speeches. Last week's Fed meeting kept rates unchanged, with Powell's hawkish remarks dampening hopes for a September rate cut. Three, economic data, including Q2 non-farm payroll productivity, unit labor costs, July ISM non-manufacturing index, June factory orders, and trade balance. Four, corporate earnings, with 124 U.S. companies reporting this week. As of July 31st, 63.2% of S&P 500 companies reported, with 68.5% beating revenue expectations, average growth 7.08%, and 82.8% exceeding profit forecasts, average growth 10.02%. S&P 500 Q2 earnings are expected to grow 6.4%, led by tech and communication services. In Hong Kong, the Hang Seng Index continued its decline on Friday, opening 29 points lower, briefly rising 84 points to 24,857, then falling to close at the day's low of 24,508, down 265 points or 1.1%. The H-share index fell 79 points or 0.9% to 8,804, and the Hang Seng Tech Index dropped 56 points or 1% to 5,397. Total market turnover was 254.6 billion Hong Kong dollars. Southbound trading volume was 133.5 billion dollars, with southbound net inflows of 12.207 billion Hong Kong dollars, marking four consecutive days of over 10 billion dollars in net inflows. For the week, the Hang Seng fell 3.5%, X-share index 3.8%, tech index 4.9%, ending 3 weeks of gains. Hong Kong ADR predicts the Hang Seng will open 129 points lower today at 24,378. Technically, the Hang Seng broke below 25,000, filling the July 21st gap between 24,826 and 24,845 and lost the 20-day moving average. It may next test the 50-day moving average around 24,200. Another gap from June 24 spans 23,689 to 23,833. Mainland China markets rose then fell on Friday. The Shanghai Composite hit 3,581 but closed at 3,559, down 14 points or 0.4%. The Shenzhen Component peaked at 11,068, closing at 10,991, down 18 points or 0.2%. Combined turnover was 1.5983 trillion yuan, down 337.6 billion yuan. For the week, the Shanghai Composite fell 0.9% and Shenzhen Component dropped 1.6%. The RMB, the renminbi central parity rate fell for 2 days, reaching 7.1496 per US dollar on Friday, down 2 pips. S&P Global data showed China's July manufacturing PMI at 49.5, below the expected and prior 50.4, indicating a decline in manufacturing activity, with slower new orders in the second output reduction in 3 months. Automaker deliveries, BYD July NEV production was 317,892 vehicles, down 0.9% year-on-year and 7.9% month-on-month. Sales were 344,296, up 0.6% year-on-year, but down 10% month-over-month, with 80,737 overseas sales, down 10.3% month-on-month. Year-to-date sales reached 2.4902 million, up 27.4% year-on-year, achieving 45.3% of the 5.5 million annual target. Leapmotor July deliveries hit 50,129, up over 126% year-on-year, exceeding 50,000 for the first time. Xpeng delivered 36,717 vehicles, up 229% year-on-year and 6% month-on-month, a record high. Year-to-date deliveries reached 233,906, up 270% year-on-year. NIO delivered 21,017 vehicles, up 2.5% year-on-year. Year-to-date deliveries were 135,000, up 25,000 year-on-year. NIO's net Tao brand launched the L90 SUV in Hangzhou, priced from 265,800 yuan or 179,800 yuan with BAAS, lower than the pre-sale price, enhancing competitiveness. NIO's CEO Li Bin said the L90 will boost Q4 profitability. The new ES8 will have a tech release and pre-sale in late August, with new day in September for its launch. Li Auto delivered 30,731 vehicles, down 39.74% year-on-year. Geely sold 237,717 vehicles, up 58% year-on-year. Xiaomi delivered over 30,000 vehicles, up month-on-month. Weak U.S. non-farm data dragged oil prices down. WTI September crude futures fell 1.93 US dollar, over 2.8% to 67.33 US dollars per barrel. Brent October futures dropped 2.03 US dollars or 2.8% to 69.67 US dollars per barrel. OPEC Plus agreed via video conference to increase output by 548,000 barrels a day in September, completing the current supply restoration phase a year early, phasing out the 2.2 million barrels a day cut from 2023 and including UAE's additional quota. A voluntary 1.66 million barrels per day cut will be reassessed by December. This shift from defending oil prices to boosting output, seen as a Trump achievement, countered geopolitical tensions and seasonal demand peaks, reinforcing expectations of a good supply surplus in second half. Plover Bay Tech Stalker 1523. Plover Bay Tech is a vendor of network connectivity hardware, software, and services with products including wired SD-WAN routers, wireless SD-WAN routers, and peripheral devices to enhance customer networks. The group also sells software add-on licenses, warranty, and support services, including subscriptions for software and cloud services, as well as on-demand data services. As its product portfolio evolves, many of the group's products now support both wired and wireless functionalities, and product expansion is not limited to connectivity products with typical SD-WAN router capabilities. The group recently announced its interim results for the period ending June 30th, 2025, reporting revenue of $62.94 million, a year-on-year increase of approximately 9.9%, primarily driven by strong growth in 5G products. Among these, sales of fixed network priority connectivity slightly decreased to about $7.61 million. Mobile network priority connectivity sales grew by 14.4% to $36.83 million. Warranty and support services grew by 6.9% to $13.44 million, and software license sales surged by 33.8% to $5.05 million. By region, North America sales slightly decreased year-on-year to $34.39 million, mainly due to certain one-off factors such as the launch of the Peplink Starlink program, which caused a sales surge in the same period last year. Additionally, the group delayed shipments this period to better understand rapidly changing trade policies, though these fluctuations are expected to be temporary, with the business projected to sustain long-term growth. Sales in Europe, the Middle East, and Africa grew by 39.2% to $20.49 million. Asia sales increased by 44.3% to $5.86 million, and sales in other regions rose by 25.1% to $2.19 million. The significant sales growth in Europe, the Middle East, Africa, Asia, and other regions was primarily driven by product deliveries to customers deploying large-scale multi-year projects in these regions. The group's profit attributable to shareholders for the first half of the year was $21.66 million, up 13.4% with a gross margin of approximately 55.5%, remaining stable compared to the previous year. The group's partnership with Starlink began in January last year and was initially limited to the higher-priced Starlink flat high-performance products, meaning the group's customer base was primarily large enterprises. The collaboration has now expanded to include all Starlink devices, opening a significant opportunity for the group to tap into Starlink's large and growing user base as a potential market. Additionally, the group has established a marketing partnership with Iridium, a global leader in voice and data satellite communications widely used in maritime and public safety sectors, with a customer base highly aligned with the group's target market. This partnership is still in its early stages but has potential for further expansion, including technical integration and cross-selling of products. Recommended buy price 6.6 Hong Kong dollars. Target price $7.4. Stop loss $6.2. I do not hold the above mentioned stock.